All right, good afternoon. It's a really warm, sunny Saturday morning and afternoon. And I have here once again with me, joining me, happy coach Jimmy and Ethan from PolicyWoke. Just give a round of applause to them.
Yay! Hi. Thanks
Welcome,
everyone.
welcome.
Good afternoon and
Thank you.
yeah, happy
All right,
holiday.
okay. So today we'll just jump straight in. We'll share a little bit of our own investment journey. So the few of us are out in our 30s, and we are not very experienced, but we do have some experience in investing and dealing with investments here and there. So we would like to share with you, and hopefully you can get something out of today's show that can help you to get started or help you to avoid future pitfalls or things, blind spots that you are not seeing. Yeah. So without further ado, okay, Jimmy, would you like to go first to share a little bit about yourself and how you get started on your investing journey, and how is it like right now?
Okay. Hi everyone. My name is Jimmy. Okay. So to share about how I started investing for myself. So long time ago, while I was working as a software specialist, my former colleague used to share with me about investing in individual stocks, and then know about different online brokerages in the market. So I still remember the first brokerage account I opened with is DBS Vickers. Okay, then I opened that Vickers account. The first stock I ever bought is Singpost. Yeah. Then I bought a few shares, and then I hold it for a few days.
Yeah, you're not holding on to Singpost now, right?
No worry. Yeah, then I hold it. Then after a month or so, the price didn't move much, so I just exit at break even. Yeah, so that's my very first stock investing experience. Yeah, so pretty uneventful, but it's okay. So fast forward till today, because of the current technology advancement.
Hi guys.
Yeah. Hi Yong-Ming.
Welcome, Yong-Ming. Thanks for joining us in this show. Yep.
Okay.
You can stay throughout. Thank you.
Yeah. So back to today's topic. So fast forward today, because of technology advancement, because I currently run my own business, PolicyWoke. I do not have the luxury of time to analyze stocks to pick to invest. So instead of cherry picking stocks to invest, I engage a robo advisor and a digital advisor to automate and auto rebalancing the portfolio or stocks and bonds portfolio for me. Then in addition, I also dabble into some peer-to-peer lending platforms to invest in business loans.
Yeah. Okay, sorry, just to pause you there, Jimmy. I just want to ask audience who are online, there are 5 of you right now, if you have any experience with robo-advisor or you're actually interested in what is it, maybe you just type some comments below, or you're just logged on, maybe just type in something, good afternoon or whatever, just let us know that you are here. Or if you have any questions to ask on investment or investing, feel free to ask below. Thank you very much. Yeah, Jimmy, sorry, please carry on with the
robo-advisor. Okay, back to the topic. So as I mentioned, I did dabble into a few peer-to-peer lending platforms to invest in a few business loans. So typically, each business loan returns is about 9 to 11% per annum, and they are typically short-term, up to 1 year. Yeah. So I have mixed results among different platforms. Some of them I hadn't got any investment default, but from another platform I do get defaulted on a few smaller amounts of business loan. But because I diversify into different business loans, net as of today I still earn a profit just from peer-to-peer lending investment. So having said that, it is important to, even if it's peer-to-peer lending platforms, right, try to diversify in small units across different projects so that you won't have a case whereby if one of the project fails, it 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 makes up a huge portion of your total investments. Yeah. So
maybe Jimmy, I can explain a little bit more what exactly is peer-to-peer and how does it work, and how do we know if it's
okay, let me just mention in general. Peer-to-peer lending platforms are platforms whereby you have two groups of people. One group is the borrowers. Borrowers are usually from companies who either need more alternate financing. Let's say they borrow some from the bank, but they need more funds, so they seek alternate financing from this platform, or they couldn't get any financing from banks, so they seek these platforms to get alternate financing. Okay, so that's the borrower side. Then on the other side is the investor side, like myself. So we as an investor, we get the opportunity to invest in these different business loans. The minimum investment amount can be as low as $20 in one of the platforms. Okay, usually the minimum is about $1,000. Yeah. So let's say I have $10,000 to invest in this platform. I try to split, into 10 counts of $1,000. That means $1,000 each across 10 different projects. Yeah. So that's one way to diversify against any possible defaults in any of the projects. Yeah.
Okay.
So that's how
has this strategy worked for you so far?
Sorry?
How has this strategy worked for you so far?
Yeah, it's done. It works pretty well. I'm investing in this for more than 2 years already. So after all these 2 to 3 years of investing, I do lose a little bit because some of the projects lost, but most of those projects it did exit with a gain. So net I still make a gain in totality of all these investments. Yeah. So
what's the homework that someone who is considering starting on this investing journey like yourself, what homework or what do they need to know before they can get started?
Okay, normally whenever a business loan project is launched for funding for investing, they do provide a fact sheet about the borrower. Yeah. So that investors can first open the fact sheet and view the fact sheet about the borrower. And then after reading the fact sheet, the borrower will again make his informed decision on whether to invest in that loan. Yeah. So that's the manual way, but there's also the automatic way, because all these platforms, they have a setting for you to invest automatically in these projects based on certain parameters. Yeah. So it depends on your risk appetite. Yeah. So maybe for beginning, you may not want to start automatic investing. You start with a manual one. So
Jimmy, is it high risk, medium risk, or low risk? What do you think?
In my view, it's considered high risk. Because you're talking about alternate financing. Usually it comes from borrowers who either cannot get financing from banks for some reason, or they couldn't get borrowed funds enough from the banks.
Yes. Agree.
So, of course, all these peer-to-peer lending platforms, they do their own risk assessments of those borrowers. Yeah, because they don't approve every single borrower's application. They do reject most of them. Yeah, so they are careful in analyzing the borrower's profile, and they did their own due diligence to filter out quality companies, borrowers to be on their platform. Yeah. But of course,
just a little general. Sure.
Of course, the investor side also need to do their own diligence
to
make their investment decision. Yeah.
How long has this peer-to-peer lending been around? And how do we get information? Let's say someone is totally new, you want to try this one. How can they find information on all this?
I do know of one aggregate platform called Seedly. Yeah.
Yep.
So Seedly has a few articles and reviews page whereby those with an account with them can write reviews about their investing experience in the platform. Yeah.
Yep.
So those
Seedly.sg, right?
Yeah, seedly.sg. Yeah. So viewers can log on to seedly.sg and feel free to view the reviews and the articles. Yeah, make sure understand how all these platforms work. Yeah.
Okay, great. So now we hand over to Ethan. Maybe Ethan, you would like to share a little bit of how you get started on your investment journey and what are some of the high points and low points and what are some of the takeaway things that you want to share with our audience.
Okay, I think it's more about getting scammed, like investment got scam.
Yes, been there, done that.
I think the first one should be talking about scam first. I think
sure.
Because I believe a lot of newcomers they are not very aware of the risk, but they are very attracted by the returns, definitely.
Yes.
If you look at if they are saying like 20%, 50% a year returns, you'll be like, wow, 50%.
I see all the money, ching ching.
Definitely, it's like ching 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 everything. They're like, wow, if I put 1 year salary, I can get 1 year salary.
Yeah.
So I actually went into one of the biggest scams in Singapore 10 years ago called Sunshine Empire.
I heard of that. I know of friends who got burnt as well. James Brown, by the way, he's out of jail and he's still doing his same old thing.
Yes, still under multi-level marketing.
James Brown,
So I was actually attracted to. Okay, the first book that I actually got introduced was the Rich Dad Poor Dad, which a lot of multi-level marketing companies do. And in fact, the theory inside the concept, you hear, wow, really fantastic.
Wait, hang on. I just got to put a comment by Yong Ming. There's a bit of lag time. So Yong Ming says strategy of application peer-to-peer lending, in my opinion, may not be so straight as there are different mean sum and tenor for each loan. So Jimmy, do you have your own strategy of picking which loan to invest, or do you invest single loan, every single loan? Yeah, Jimmy, maybe I'll take this question.
Okay, thanks, Yong Ming. Okay, so personally for myself, it's my own choice. It may not work for you. So for me, I just set automatic investing with minimal investment amount. Yeah. Because in the beginning, I do read fact sheets first before I invest manually. But later on, after about 1 year, I started turning on the automatic investing. So I just turn on, invest minimum, and just let it invest automatically. So, but that's just me. It may not, just to highlight, it may not work for you. So
something to highlight also, the strategy that you use actually really depends a lot on what's your investing character, what's your psychology, and what is importantly what's your risk appetite. So these two factors you have to bear in mind as well. Thank you, Jimmy, for your answer, and thank you, Yong Ming, for your questions. Keep them coming. Thank you very much. So now we hop back to Sunshine Empire with Ethan.
Okay, so I have to say that it's really the concept and the idea that actually attracted me. Okay, I was also looking at trying to find a breakthrough because I don't come from a very rich family. And I didn't have a lot of things to begin with. So that is where it will be like, hey, I want to have something that my friends do have. So that was the pure intention. It's not really like, oh, I want to earn $1 million, whatever. It's really just to like, I really wish to enjoy things that my friends have.
Identify with that.
Alright. So if I'm able to do it with my family, then I have to do it by myself. Definitely, right? So 钱不是从天上掉下来的。
Yes,
correct. You have to work for it. Correct. So, but if you look at it in that sense, the returns 你也不知道if 50%钱好像从天上掉下来的。so there's this disconnect. If you look at it, on one hand they are telling you 钱不是从天上掉下来 money doesn't come dropping. But on the other hand, it's telling you that investment is able to reap that. So
Yes, absolutely.
yeah, so you need to understand that whatever you do, if the returns are high, definitely there is a catch. Always.
Yes. Always confirm.
Always.
Must
You must understand that there is a catch. So always question that first. Number one. So if the person is unable to tell you that, then it's not a very good investment already. It's likely a scam already. Yeah. Yeah. So that was
Or it's
how I
very
guess.
opaque. Information is very opaque. You try to find out about a company, and then you find that there's this weird looking website that is hosted by some island in somewhere in the world that you haven't heard of before. And then you try to find the trace back. Yeah, it's just the whole thing is very opaque. The more opaque it is, the more alarm bells it should be ringing inside your head. Alright, please carry on. Ethan. Yeah.
Yeah, so that was my first experience with investments already. Yeah, so but,
Okay,
but
not,
from
not a
there-
good start, but what?
yeah, it's not a
went on
good
after
start.
that?
Correct. So from there, I start to learn more about trying to identify business opportunities. Yeah, because it's either you work hard for yourself or you work hard for someone else so that they reward you.
Yes.
Yeah.
Yes.
So
The four quadrant lah. Yes.
yeah.
E,
So
D,
I was moving about. Then I felt that okay, maybe I should start with employment first. Yeah, since that is the most straightforward and
most people
I
start
did.
with that.
Yeah, I don't have a lot of mentors. My mentors in my multi-level marketing are also very different from me. The values are very different from me. So,
Driven
so
by
that,
different things. Just put it that way.
correct. So that there is nothing, or I would say that their methods and their ideas are totally different from me. So that is that I can't use it. It can be very good, but I cannot use it. So
it's just not used.
So I started with employment, and because I already pre-planned my life already, I would be getting married at a certain age, like 28 at that time. Yeah, so I already had plans with my then girlfriend, now wife.
So how old were you when you started making plans? How old were you?
Wow. Okay, I met my wife during university first year.
Oh, okay. Great.
Yeah, so we started to plan probably like fourth year. Fourth year in the university.
So 25?
Yeah, 24. About 24.
24. Yeah. Okay.
Yeah.
Okay.
So for me, I like to do planning. So I will have planned until like 28, 30, 35. So all along the way, you can see that I will have to use a lot of money. So my investments are mostly in my high interest saving account. So I will just save that.
Okay. Yes.
Yeah, because I already have a target, and renovation will be one cost already, at least at 20.
Yes.
And my parents, they all also need to get some expenses from me lah. So I need to give a bit of allowance or that. So I did my figures. I save, I'll be using it already. There is nothing much for me to invest also.
But I'll say that, Ethan, I'll say that you are actually a very disciplined saver and you can stick to your budget, right? Am I right to say so?
Yes. Yeah, you can say that. So that's why whatever I save is really meant to be used already.
Okay. So guys, for people who are out there listening to this, one of the key success strategies is really to be very disciplined in your budgeting. Yeah, so there are two trains of thought. You can either control your expenses or increase your income, or do both if you want to increase your wealth. Yeah, so this is one of the factors, being very disciplined in your spending and sticking to your budget. Not to say that you can't have enjoyment here and there, but you just got to have a budget and you just got to stick to it. Because what happens is most of the time people, they don't stick to their budget, they don't track their expenses, and then at the end of the month they find that the amount inside the bank account doesn't look as expected. Yeah, because when you don't keep track of your expenses, in this digital society, everything goes by credit card, goes by a few numbers that you type on some website somewhere, and in a different currency or different kind of point system. Yeah, it's so removed that sometimes we just forget what you spend. Yeah, but Ethan, I believe that you are very disciplined.
Yeah, so I really started my investment journey at 30.
Yep.
30, year 30. So it's 3 years ago. Yeah, and
okay.
It was because I can amass at least like a 20K to start investing from that
Yes,
time.
that's a good
So
model.
previously, all my money was used for renovation, or housing, or that, or wedding. Wedding was also a amount. Okay, because for me, when I plan my wedding, right, I choose the people that I want to be in my wedding, and not because
Yes.
they can give me the biggest angpao.
Yes.
Yeah, and
That's the right way. Very good.
I have friends who actually invited every other people who can deem to be really good big angpaos, so they actually
I
invited
won't
those
comment on
people.
that lah, but that doesn't resonate with me as well. Yeah, that absolutely. For me, I'll choose the people who have crossed path with me in my life, and they have made an impact in my life, and I've made an impact in their life. Yeah, that's really my yardstick. Yeah. Thanks for sharing, Ethan. Yeah. So yeah, please carry on your journey. So how is it
So
like?
it's a lot about expenses. Then finally I managed to amass about 20K. I started to invest in robo advisors, specifically StashAway.
Right.
Yes.
So how has it been so far? Your experience with StashAway?
Pretty good because.
Oh, by the way, we don't get anything on StashAway. I'll just mention that. I StashAway if you are here.
Yeah, also
Yeah.
Yeah, so the onboarding process was very smooth. They do have also their own investment talks or seminars,
Yes.
and I felt that it was very informative for beginners.
Yeah.
Okay, for me, even from that time during Sunshine Empire, that was when I was in the army. So
Yes.
in fact, my investment knowledge accumulation started from that time. But I officially started investing only at age 30. Isn't it weird?
Yeah. Actually, no, actually it's not weird. Actually, it's a very important point. Another success factor in your investment or investing journey is really knowledge. You cannot don't have knowledge and you cannot dive in blind. Yeah, a lot of people dive in blind. I myself included, dive in blind before. So if you dive in blind, you only you only find yourself hitting the rocks because you're diving in blind. So acquiring the correct knowledge is actually a very important factor to success in your investing journey. And you cannot, like it or not, you cannot take shortcuts because investing itself is also a skill that you need to learn. It's also a skill set that you need to master to be able to do well. It's not just don't be fooled by people who tell you that it's no effort, require little effort, just go in. Yeah, even if you're investing with a trader or you're doing like insurance plans and all that, all those kind of instruments, you also need to do your research. So having the knowledge, equipping yourself and understanding the fundamentals of how to look at investment instrument and how to determine if something is worth investing in, I think that's very important. So Ethan, you have not wasted your many years in between. It's not wasted.
Yeah.
Now you're sowing the seeds many years ago. Now you're reaping the fruits.
Yeah, in a way, because it is quite difficult to amass so much knowledge in a short time. And like what Jimmy mentioned, CD is actually a platform. Yeah. Also, we don't take money from CD. There's no advertising fee for them also. Yeah.
Right.
So I was able to compress and compartmentalize those knowledge and start sharing constantly. So they actually benefited from my 10 over years with a loss of $6,000 in Sunshine Empire. As a tuition fee for myself, I'm sharing
tuition fee
over there.
Tuition fee. Yeah. I paid my dues as well. Yeah. Please carry on.
So for beginners, I really think that it's good to have an automated platform first, and the platform must at least not be a scam, number one.
Based on that point, how do you choose StashAway, or how can someone make a choice if they want to get started on the robo-advisory investing journey? What are the factors that they need to look out for to choose one of the many robo-advisors out there?
For me, I always look at number one, what is their investment philosophy?
Yes.
Yeah. So the philosophy should be, at least to me, realistic and logical,
Absolutely.
and definitely backed by data lah.
Absolutely.
So if it meets these three, then most likely it would have covered all the risks.
Yes.
Because when they did their research right into their methodology, they definitely have to look back at their risk lah. So what is the highest drawdown,
Yes.
or basically how much money you can lose in the meantime, within paper losses. So they definitely know their stuff. Then that is legitimate at least. Yeah. So that's what
What
I
else?
look up.
Yep.
The
Anything else that
others
you
is
talk about?
more about yourself. You need to understand yourself also. So if you cannot take, like, if you lose 20% of investment, you cannot sleep. Don't invest in that.
Yes. Okay, viewers, this is another thing that you need to write down. If you find that you one day your stock drops 20% and then you cannot sleep, I think it's better that you don't invest. Yeah, you need to know you need to understand your risk appetite. I think we have just mentioned it and we mention it again. Understanding your risk appetite is very important. So Ethan, I got another question. Actually, Ethan and Jimmy, any of you can take. How much does it take to get started? What's the minimum amount that someone need to get to save to make sense to get started on your robo-advisory investment journey?
Because each robo-advisor and a digital advisor have a different minimum investment amount.
Okay.
So for example, AutoWealth, minimum investment amount is 3,000 Singapore dollars.
Yep.
That is partly because the AutoWealth account setup is such that every client account is legally segregated in their own legal name. So no commingling. And then because no commingling means there's no fractional shares. So by math, right, you need minimum 3,000 Singapore dollars in order to build the bare minimum portfolio of stocks and bonds ETF without fractional sharing. Shares. So that's for AutoWealth. For Endowus, the minimum investment amount is 10,000 Singapore dollars.
Yes.
So it's last time I heard from them that 10,000 minimum is partly because of their it's a very long reason, but it's their business decision. Because 10,000 is enough to.
It's a trade-off. There's always a trade-off, because if you make it higher on their side, their cost will be lower. Because if you make it lower, their transaction cost as a percentage will be higher.
Yes.
So that there'll be a trade-off. And then, but the bad thing for them is that then they'll lose out on those who do not have 10,000 to start with. So it's always just a trade-off.
Moreover, and also a setup whereby every client's account is legally segregated.
Yes. So that's a very important factor. I hear you mentioning that a few times. That's segregated, legally segregated.
That's in my own view. In my own view, having accounts segregated is important. Because there's no fractional shares, right? Then even in the event that the digital or robo-advisor were to cease operations, right?
Yes.
Because of legal segregation, the clients can still have their accounts with shares belonging to him or her.
Yes.
So there's a less likely, there's a very slim chance that there's a need to liquidate all the shares because of a robo-advisor ceasing of operation.
Yep.
So that's my view.
Very good. How about you, Ethan?
Okay, for me, I adopt a more we call it risky approach. Based on what Jimmy says.
You got higher risk appetite.
Okay, I'm okay with fractional shares as long as they know I'm the owner. And a small amount, like even $100 a month, right? You can put in a robo-advisor first, Then there are even strategies where people write articles saying that you can put
Dollar
in
cost averaging, right?
correct. You do into all these smaller robo advisors first.
Yes.
Then once you have a more substantial amount, you can shift to where you own the shares instead.
Yes. All right.
Yeah, so that's the good thing about having no minimum. So I'm the more risky kind. I'm okay to invest all these fractional shares. Yeah, because every bit of money is working hard for me. So that is my idea.
Absolutely. So if you don't mind asking this question, you can give a ballpark range. How much average ROI are you guys getting out of these investments?
For me, okay, I don't really check the numbers. I seldom log in and look at the numbers.
Or the last time you look at it, how was it?
I can say it's positive, but it's never negative.
Okay, is it more than the inflation?
Yes, it outperforms the inflation. Yeah.
Absolutely.
Even for global advisors. Yeah.
Oh, I adopt a more buy low, sell high. I'm a bit of a market timer. So
okay.
For some of my till date, because I liquidated all my shares in robo advisors to start my business. Yeah. So if I have to look back at that performance, because it was going up, yeah. So it was about 15%. 15%.
Excellent. Okay, we got a question from Yong Ming. Sorry, the comments come a little bit laggy, so we just pop in here and there. So what percent of portfolio do you recommend to invest in alternative or robo-advisor? Jimmy, you want to answer this?
Okay. Because I'm not a financial advisor, so I cannot make any recommendation. Yeah.
But what would you?
What I can say is because some of the robo-advisors and digital advisors, right, they have a team of licensed financial advisors who can advise you on your portfolio recommendations. Yeah.
Yes.
So I believe, let's say Auto Wealth and Endowus, like an example, they both have their respective team of financial advisors. Yeah, you are free to seek advice from them. Yeah, to find the recommended portfolio composition for you.
Yeah.
So that's what I can say.
How about you, Ethan? How will you answer this question? Okay, we are not giving advice here. We're not supposed to, but we'll just share from our point of view. So, Ethan, what will you do?
Okay, I will have to look at because it is a very difficult question to answer if you were to look at the holistic investment portfolio. Yeah, at least from my knowledge. Because you could invest in a lot of things, but you could be investing in the same thing. It's like I invest in robo-advisor 1, robo-advisor 2, robo-advisor 3. So their composition may be different, but the things they invest in could be the same.
Yes.
For example, in the index fund, you got UOB for STI, just to make it. I'm not saying STI is a good index. I'm just saying for educational sake. You got UOB, DBS, and OCBC, right, in the index. So you could, for yourself, you could be buying the stock and shares of this. Then you buy the index. So what are you doing? You're investing in the same thing, it's just different percentage only.
There's no overlap, I would say.
Yeah, there's a lot of overlap. So it is better that instead of saying how much percentage you put into a robo-advisor, you should be looking at how much you're putting in the components itself, and you need to understand at this. And most fund fact sheet or funds, any fund, be it ETF, be it in the robo-advisor, they will tell you what you're investing in. So that is more important, I think. Instead of looking at percentage of your portfolio, but rather percentage of what you put into each of these different companies. That should be the main thing.
Yes. Yeah. Well, I actually just put in a disclaimer below. You can just see advice given on own experience and opinion. So you have to do your own due diligence. Yongming, thank you for that question. How I'll answer is I'll ask you a question back. What is your risk appetite and what is your goal. Yeah, you have to understand your own risk appetite. It comes to this again. Any investment you can make money for it if done rightly, but the flip side is any investment can also lose you money and lose you a lot of money. Yeah. So you have to ask yourself, what is your risk appetite? Are you a more conservative investor like Jimmy, or a bit more adventurous, high risk taker like Ethan? Yeah, you got to know yourself, and you have answer to this question. What you can do or what we can do is we can share our experience, how it has worked for us, how it has not worked for us. End of the day, you still have to do your due diligence. You have to do your research. You have to do your learning. You have to do a read up. And if you have an advisor, a financial advisor, please consult him or her. Yeah, that will be the best course forward. This show is really just for our sharing. It's not meant for us, not meant for you to take. Well, tomorrow STI will go out there, you can buy. Hey, sorry, it's not meant to be like that. But it's just meant to be a sharing session. So everybody, the viewers who are watching, please take it in the right spirit. Yeah, that is the right spirit. We're just sharing. We're just sharing our own journey, what has worked for us and what has not worked for us. Yeah. So let's move on to the question about the final point that we'll cover. We only have less than 10 minutes left. The risk-reward trade-off we have mentioned briefly at the beginning. So maybe Jimmy, you would like to offer your take on this. What is this risk-reward trade-off and why should we be concerned? How does it affect us?
Okay, so from my own experience, right, usually whenever an investment instrument, when you read the fact sheet and all that, is determined as high risk, usually the reward is high. So what I mean by that? So in most cases, let's say back to the peer-to-peer lending platform, most cases, whenever there's a business loan opportunity to invest, right, and then because some platforms they did have a alphabet system like A, B, C, E, D, right, to determine the probability of a default. Yeah.
Yes.
So A means least likely to default, then D means most likely to default. Yeah.
Yes.
So usually when the alphabet link towards D, right, the return on the loan is one of the higher end. You're talking about 12% per annum. Yeah. Then whereas if the alphabet is like towards A, like maybe A or B, right, then the returns on the loan is a little on the lower side, let's say 8, 9 or 9.5% per annum. Yeah. So this is one example of the risk reward trade-off. Yeah. So you have to think for yourself on whether are you willing to take high risk based on that alphabet.
Yes.
Or in return for higher returns that up to 12% per annum. Yeah. So that's you have to ask yourself. Yeah. So that's
absolutely. Thanks for sharing, Jimmy. All right, Ethan. So how about you? What's your take on this risk-reward trade-off? How do you actually manage this risk-reward balance? Where is the balance for you?
You have to say it in this way. I'm not a very high risk taker in terms of risk-reward trade-off. Yeah, because of my experience with Sunshine Empire and many of the other businesses, I've seen businesses making a lot of money. I've seen businesses make money that suddenly lose money.
Yes.
So my number one idea is never lose money. Okay, so
never lose money. Okay, so this is very important. Okay, those of you who are watching this, please write this down. Write this down. Never lose money. Never lose money. Okay, most of us have the misconception that investing is all about making a returns. That is not the number one priority. The number one priority is how not to lose money. Because fact of the matter is, again, we go by numbers and stats. Most people, they'll lose money. Most retail investors, like those of you who are watching this show, most retail investors, they'll lose money. That's the fact of the matter. And less people, they will actually make money out of this. So your number one priority, right, as long as you go into any investment, you need to ask yourself this question: how can I not lose money? How can I minimize the risk of my investment? Yeah. So you always need to ask this. This has to be at the back of your head. Yeah. So write this down. Very important. Okay, Ethan, please carry on.
Okay, so how do I balance that reward with how to not lose money?
Yeah.
So let's say I have $1,000. If I have $10, I can invest in 100 different things, right?
Yes.
So I have a spectrum. So some investment may be $10, you can lose the whole $10. Some maybe I can only lose maybe $1. So I will try to balance by blending all the returns together. We try to look at individual, what are their returns.
Yes.
Blend it together with the possible loss. Most probable loss and worst case scenario. So if my worst case scenario enables me not to lose any money, that is quite good already. And then I look at my probable scenario. So if my probable scenario tells me I can earn at least 10% per annum, that is fantastic to me.
Excellent.
So that's how I look at it. The risk reward trade-off.
Yeah. So we only have 4 minutes left. If you have any questions, feel free to type below, or you have learned something from today's short sharing, please feel free to type below and let us know as well. So I just have one final question to wrap up this show. So what is it like moving forward in the next 6 to 12 months for you guys? Jimmy, maybe you want to share first?
Move forward in terms of
investment instruments and all that.
For me, within the next 12 months, the investment strategy unlikely will change much.
Which is what's your
I'll still continue to stay invested in current accounts with global advisors, digital advisors, and those peer-to-peer lending platforms. So investments allocation is still didn't change much.
Okay. How about yourself, Ethan? Maybe you want to share from your perspective.
For me, just go with the flow, understand the economy, and I believe most funds will try not to lose money.
Yes.
So just stay invested, like what Jimmy say, just stay invested, because the market will go up in the long run. So if you are a long-term person, right, you don't have to worry about losing money. But if you are a short-term person, I think you should reanalyze why you are short-term in the first place. Because investment will not lose money in the long term. That's a fact.
Just on that point, I just want to ask you guys, what is the investment time horizon that you guys are looking at? Maybe Jimmy, you want to share first?
You're talking about long term, so at least 10 years, 20 years. Stay invested and survive any financial crisis that is coming. Whether there will be financial crisis in the future or not, stay invested. Do not panic, sell. Do not sell just because you panic when the stock market goes down.
You'll be doing the opposite of what most people try to do. Most people try to buy low and sell high. If you panic, right, then you might be selling low, and then you want to buy again, you might be buying high. Ethan, how about you?
Okay, for me, it's more about reviewing at least your investments every 5 years.
Yes.
Because the economic change, especially now, economic cycle has been changing a lot. So it is a bit more deeper, the knowledge. So I'm talking about economic cycle. So every 5 years, there might be a shift. Even we can see in 2008, 2013, when there was a euro crisis, then 2018 until now, there's COVID. So you can see that it starts to shrink already, the economic cycle. So it's good to have a review, but you don't have to buy or sell, just review to understand whether your investment philosophy is still aligned with the economy.
Do you guys practice portfolio rebalancing? or you all just stay consistent? Do you rebalance, review, rebalance, or you just stay consistent?
For me, because I happen to use those robo advisors and digital advisors that does the automatic rebalancing for me. Yeah. So, so for information, my portfolio allocation in those are 60% stocks and 40% bonds. Yeah. But this percentage is based on my own risk profile. Yeah.
Okay.
It may not be suitable for everyone.
Yes, got it. Absolutely. Yourself, Ethan?
Okay, I'm purely almost 100% equities if you are looking at that. But because of my business, so that business is the bond priority. So if you have to look at in totality, yeah, it's in fact I'm bond heavy already. It's 80-20. Yeah.
Okay, got it.
Yeah, I understand.
All right. Okay. Thanks, guys. It's been a pleasure having you guys here, and thanks, Yongming, thanks for all your questions. I hope Yongming, you have learned something from this little session today. So what's going to happen is 2 weeks from now, our good guys at PolicyWoke, Jimmy and Ethan, unfortunately can't join us, but I will be having a real estate realtor, a real estate agent. He's actually pretty known. He's been appearing in media. His name is Clarence Fu. He'll be sharing a little bit on his know-how and his expertise. So stay tuned for 2 weeks later on the 28th of November, same time. And then after that, in December, we'll welcome Jimmy and Ethan back again. All right, so thank you for your time. That's all we have. The Happy Money series, and stay happy.
Happy holidays.
Happy holidays. For those Hindus, yeah. Happy Diwali.
Yeah.
Thank you. Bye-bye.
Okay, bye.
Bye.
Have a good weekend. Bye.